Hello there and welcome. I'm Tushar Chande. Are you new to technical analysis and were you wondering how you could determine the long-term trend consistently and confidently in order to become a better investor? I can help you with that. You see all those indicators in the blue box below? I've invented every single one of them and a whole lot more. I have tons of trading experience, so I can help you understand how to determine the long-term trend and become a better trader. So let's get started. Here's a quick disclaimer that says that past performance is not necessarily indicative of future results. So why is it important to understand what the long-term trend is? It's important for investors and retirees, and what you're looking for is a simple solution, something that's easy to understand and implement, but that's very robust. That is, it's not going to be too dependent on exactly how the parameters are defined. The problem is that the markets are very noisy, so it's difficult to tell the forest from the trees. The other problem is that the moves have become compressed and accelerated. So for example, during the COVID-19 sell-off, the market fell like 33% in 5 weeks. And say 20 years ago, a move that big might have taken 5 months or even 20 months. And the other challenge is that there are way too many opinions. The barrier to entry is very low, so anyone can get on board and express their opinions. So what you would like is to have a way to have your own method, something that you understand and can rely on. So what are the assumptions? The first assumption we have to make is that we don't know what the market will do. So we have to be humble. The second is we don't know when the trend will change. The third one is we don't know how long the new trend will last. And lastly, we're looking for a robust, non-optimized solution that we can use confidently in the future, and one that's not reliant on historical data. So here's the solution. We're going to use a 12-month SMA with delay. What does that mean? The SMA stands for Simple Moving Average. It's a type of computation, and I have another video for it that you can look for in my collection. The delay is for 1 month. Now, why do we want to use this approach? First, it's easy to compute. And second, because we have 1 month of delay, throughout the new month, you know from the old month what the reference value is to understand or decide that the trend will change or is about to change. So let's look at a chart. This is the monthly chart of the S&P 500 index. Each bar represents 1 month of price action. So each bar tells you the highest price for the month, the lowest price for the month, the entry price, that is the opening price of the month, and the exit price, that is the closing price of the month. The dashed blue line is a 12-month simple moving average in which we just take the average of 12 months of data with a 1 month delay. So what that means is we calculate 12-month moving average for the previous 12 months and plot it under this month. So we have a 1 month delay. So this is the same chart as the previous slide, but we have simplified it by using only the monthly closing prices. The dashed line is still the 12-month simple moving average offset by 1 month. And when prices are falling, we've painted them red. When prices are rising, we painted the line green. So each individual data point is the monthly close of the S&P 500. So if you look at the 2008-2009 period, we know we had the big sell-off due to a recession, and you see the prices closed below the moving average and stayed there. Then the market recovered and the trend changed again. And then if you look at the 2000-2003 sell-off, prices rose beautifully, turned lower, and stayed below the average for a long period of time before they recovered. So if we make our rule that the trend is up when the close is above the moving average and the trend is down when the close is below the moving average, then our whole analysis is greatly simplified. And as this period here shows, or this period here shows, or this period here shows, when there's a long and sustained trend, this model will keep you aligned in the direction or with the direction of the major long-term trend. So for example, if you look at this period from here to here, it closed above the 12-month moving average and stayed there for many months. look at from here to here. It went above the average and stayed there for many months. So this 12-month simple moving average with monthly closing data will keep you aligned with the primary trend in the market. So this is the same chart as the previous slide, but we have written out our trend rule. We are in an uptrend when the close is above the average, and we are in a downtrend when the close is below the average. Once you can determine this information based on actual data and not on anyone else's opinion, you can now configure your portfolio strategy as an investor to be long the market or out of the market if you so wish, based on purely mathematical analysis of the data. So in this chart, we have put in up arrows and down arrows to show where the trend has changed, and I want to highlight what I call whipsaws. So if you look at this particular area, we had multiple changes in direction. That is, the close was below the average and it went above the average and below the average and above the average before staying above the average in a sustained way. So one of the challenges of using a trend following system or model based on moving averages is that we can have whipsaws. So here we had a long period of consolidation of many months in which the prices fluctuated around the moving average. And whenever that fluctuation occurs, we get signals or changes in direction which are not sustained. So that's one of the challenges of using such a simple but robust decision rule on whether the trend is up or down. So let's zoom in on this consolidation I showed you in the previous slide and talk about a few terms. One of the terms I want to talk about is deviation, which measures simply the distance of the monthly close from the monthly moving average. And then I can divide this distance by the 12-month standard deviation so that I normalize the data, and it's much easier to look at a long period of data, say from 1950, and I'll show you what that means or how it looks. And then here's a whipsaw. We had a close above the moving average, then a close below the moving average, so we have a change in trend. And then very shortly, only 2 months later, we had a close above the moving average, so we had a change in trend, then it closed below again and above again. So this distance between a change in direction is a length of the signal, and I'll show you what the long-term analysis or distribution of these lengths look like. So this chart looks complicated, but it shows the deviation of the close from the moving average divided by the trailing 12-month standard deviation. So we have normalized it. We're expressing the deviation or distance of the close from the moving average as a multiple of the standard deviation. So for example, when you see a value like 4 or 4.5, it tells you it was 4.5 standard deviations above the moving average. So whenever the prices were above, I plotted them in green. Whenever the prices were below, I plotted them in red. So for example, here we had a long drawdown or period below the average where it turned red, bounced around before it turned green again. Whereas here we had a relatively short excursion below the moving average. So this gives you a sense for what the deviations look like. When the trends are higher, it's all green. When the trends are lower, it's all red. And we can look at the length of each trip below the average, like I showed you in the previous slide, and analyze them to understand what the long-term performance looks like. So let's do that. So this is a frequency distribution of all those widths or lengths of the time that we spent below the moving average, all the red line widths that we saw. So this is the number of months of each duration or trip below the line, the average, and this is the frequency of occurrence. So there were 8 occurrences which stayed 1 month below the line. Then there were 7 where we spent 2 months, and so on. And there were about 7 where we spent more than 10 months below the line. So the goal of the model is to avoid this scenario to the right, where we want to be out of the market when it's going to spend a lot of time in negative territory below the 12-month moving average. So that's the goal of the system or the model. So what are the advantages of the model? It keeps you on the right side of the trend. You can avoid long downtrends, say longer than 6 months. You can capture long uptrends, say longer than 6 months. It's easy to check because you only have to do it once a month. And it's easy to manage because if you want, you can maintain the 12-month moving average by hand. So what are the disadvantages of the model? The first one is that we have whipsaw risk. So I showed you the chart where the average is sort of flat and prices consolidate around the average. Then we get multiple changes in direction spaced very close together in time. That's called whipsaw, and we can get whipsawed as I showed you on the chart. Also, it does not catch the high or low of the move because we have to wait for it to close below the average or above the average. So if you have a strong move, it will take many months for it to close below the average and so on. And of course, so it seems that the model is slow to enter and slow to exit. So there's an opportunity cost of remaining with the position when the direction is changing or not having a position when the direction is changing. Well, thank you very much for staying with me throughout the slide deck. I have a toolkit for Metastock called Tushar Chande's Complete Toolkit for Metastock 18 that's very easy to use and learn. It's simple but powerful. It's very clear, it's unambiguous, just like the model I showed you. You can use it on any time frame and you can use it on anywhere. By that I mean any type of instrument and exchange. And you can get that by visiting metastock.com/Chande.